Hi, I'm Brian Cordes, head of the Portfolio Specialist Group here at Cohen & Steers. In 2020, we often talked about the dual challenge of finding income in a historically low rate environment and protecting that income from taxes. Now here in 2021, investors face a triple challenge of sorts. Still looking for income in a historically low rate environment. Tax protection perhaps takes on greater importance given President Biden's tax proposals. And now investors face the additional challenge of preserving capital in a higher rate environment. While we do believe that the Fed will remain on the sidelines in 2021, we also believe that with additional stimulus and a successful vaccine rollout, that both of those could be catalysts to improved economic activity, which would be the impetus for a move higher on the long end of the curve and potentially put bond prices at risk. We believe that a unique solution to meet these three challenges is low duration preferred securities. Why is that? Well, for one, preferreds generate a high level of income. Two, much of that income will be treated as qualified dividend income, which will provide a certain level of tax protection. And third, their low duration structures can help preserve capital in a period of higher rates. I'll touch on each of these now a little bit more. First, preferreds do generate a high level of income. The majority of preferreds are going to be issued by highly regulated and/or stable cash flow industries. And as a preferred holder, while you do have a prioritized claim to the assets and dividends over that of a common shareholder, you are subordinate to the other creditors within a corporation's capital stack. And it's because of that subordination risk that preferreds tend to have higher yields relative to other similarly rated bonds. For example, as we entered 2021, an index of low duration investment grade preferred securities was yielding 3.1%. This was materially higher than other investment grade low duration bond groups and wasn't all that far behind low duration high yield. Second, tax protection. The majority of preferred income is going to be treated as qualified dividend income, as preferreds are often treated as equities for tax purposes. As such, qualified dividend income is taxed at a top rate of 20% versus the top ordinary income rate of 37%. Now, there are a couple of things to consider with President Biden's tax proposals. First, he has proposed that the income tax rate for the top bracket would move from 37% up to 39.6%. In addition, he has proposed that for those making $1 million or more, that QDI for those individuals would be taxed at 39.6% versus the 20%. However, those in the top bracket that make less than $1 million a year, they would actually see a greater benefit this go round from qualified dividend income, because they would still be taxed at a top rate of 20% versus their ordinary income rate, which would now be 39.6 instead of the 37%. No matter your situation, our calculations show that low duration preferred securities can provide a superior after-tax yield advantage over other areas of fixed income. Third, capital preservation. Preferred's low duration structures can help preserve capital in a period of rising rates. The preferred universe as a whole is $1 trillion in size. Within that universe are two different markets, the $25 market and the over-the-counter market. In the $25 market, the standard structure there is a fixed rate perpetual security. Given that fixed rate coupon for life, they're much more sensitive to moves in demanded yields. However, in the over-the-counter market, the standard structure there is a fixed to float security. And many of these securities are just a few years away from their floating rate period. Moreover, floating rate preferreds, their income rates will reset off of moves in short rates, such as LIBOR, meaning they have little interest rate risk. At Cohen & Steers, we manage the only low duration preferred securities portfolio in the market today. Our emphasis on generating a high level of income from a portfolio with a targeted weighted average duration of 3 years or less leads to potentially some of the most attractive income per unit of duration you will find in the market today.